Welcome to the Market Pulse podcast from Equifax, where we break down the latest economic and credit insights to help you navigate today's business landscape.
Welcome to the Market Pulse podcast. I'm your host, Emmaline Aliff, leader of the Equifax Advisors. As a group, the advisors identify economic considerations and leverage data and analytics to translate into industry insights and recommendations for you. The goal is to support our clients during economic uncertainty while uncovering growth opportunities in consumer and commercial credit risk. Today, we're focusing on how macroeconomic forces are impacting the auto market. I'm pleased to welcome our guest, Jeremy Robb, Chief Economist at Cox Automotive, who is a leading expert on the auto industry. As Chief Economist, he oversees Cox Automotive's enterprise-level economic outlook, monthly forecasts, client advisory, media briefings, and the strategic integration of data drawn from across the company's extensive retail and wholesale platforms. Welcome, Jeremy. Before we jump into our main topic, we'd like to level set with our brief economic update from economist Justin Begley at Moody's Economics.
Global economic uncertainty has spiked once again thanks to the ongoing conflict in the Middle East. Oil prices have jumped about $30 a barrel since the conflict began, and the price of regular unleaded gasoline has increased by about $1 per gallon. Freight costs have also spiked as the Strait of Hormuz, which is a key choke point for the shipment of energy, agricultural, and industrial goods, has been essentially closed. Traffic through the strait is down by about 90% since the conflict began. The supply disruptions have reignited inflation fears, putting central banks on watch. In the U.S., the Federal Open Market Committee kept the Fed funds rate unchanged between 3.5% and 3.75% at its March meeting last week. The Fed has kept the policy rate steady for the last 3 of its meetings as it watches how the U.S. economy adapts to earlier rate cuts, tariffs, and of course, the more recent supply shocks. Like tariffs, an energy shock is a hit to supply, and monetary policymakers can do little to head off any of the resulting inflation. Monetary policy is really a demand-side instrument. Therefore, the policymakers have to determine whether or not it's prudent to wait and see how things shake out, and that seems to be what the Fed is doing for now. Though the worst effects of the tariffs are likely behind us in terms of inflation, the severity and duration of the oil supply shocks are at this point unknown. Inflation expectations, though always important, have therefore become crucial to watch. The effects of high tariffs and energy price shocks are coming after 5 years of above target inflation. And while expectations remain anchored at this point, if businesses and consumers start to embed higher inflation into their own decision making, the Fed will be forced to once again tighten policy.
Thank you, Justin. Welcome, Jeremy. Happy to have you back. I know we've had you featured on our Market Pulse webinar recently in January. And then also I had the opportunity to hear some of the great things you had to say at the Auto Week in Las Vegas. So you're really looking forward to our conversation today in part of our podcast.
Yeah, thanks for having me. It's I know we talked just about a month ago, and that month has gone by really quickly, and here we are, into March now with everything happening in the automotive space and lots of things around the world happening too. But we're also right in the middle of a tax refund season, which is really a fantastic time to talk about what goes on in the automotive market.
Yeah, it is a fantastic time. And so, as we head into this, one of the things that I found particularly interesting is when we were going into the Auto Week, I gave a presentation and we had an extension of that. So it was submitted 6 weeks before my presentation. And during that time period, there were 35 substantial changes that I would have made across the content. So just over 6 weeks. So I imagine all the things you're going to talk about today, how much things could have possibly changed since that time as well. So
yeah, I think if any of us learned anything from last year, it was you need to be nimble in your thinking and not just 100% dialed into exactly one view of what's going to happen when you talk about what's going to happen in the future because things change pretty quickly right now in the environment that we live in, especially in the automotive space.
Absolutely. So why don't we get started here? Because a lot of things we've been hearing, and I've heard you talk about it as well, is the K-shaped, economy and how behavior has been playing out. And of course, that means a lot of things across industries. And I imagine you have your perspective on what it means for auto that I'm really looking forward to diving into. But when we look at that macroeconomic picture through the lens of Cox, automotive data, along with any form of consumer credit health that we watch through our market pulse index and credit trends, we see deeply bifurcated K-shaped with some expansion and divergence on the tails, especially. And I saw some things published with dealer track credit availability data, showing a 2-year high. And I know if you go back in time, it may not have been that necessarily, but maybe you can help us as the chief economist reconcile and then expand it wherever you'd like to go with respect to understanding how that could be with tightening consumer wallets or loosening of credit. What are some of the behaviors you're observing?
Yeah, there's a lot going on. Affordability continues to be maybe like the number one thing that people talk about in the United States as it relates to consumers, specifically when we talk about big ticket items like purchasing a vehicle or a home or something like that. They're very interest rate sensitive. Inflation acts just like stock market returns do. It compounds. Your 401k, the stock market, you want that to compound every year. The problem is that inflation does the same thing, but we want it to happen at a lesser pace, and we haven't seen a lesser pace for several years now. Actually, the average rate of consumer price inflation over the past 5 years has been 4.9% on average. We started to come down some in 2024, 2025. We rose back up. A lot of that was due to the tariffs out there, and that continues to put pressure on consumers. A lot of people think that as we move through the first half of this year, we'll continue to see impacts from tariffs, and we are seeing that, especially on the new vehicle side with pricing and things like that. And then maybe it gets a little bit better as we move into the back half of this year and then going on from there. One of the things that you think about the K-shaped economy, I've done quite a bit of work on this and what it means for consumers in terms of how much they're spending on owning their own automotive or automobile, having private mobility access every month. It shows that the highest end consumers are really pretty good. And that may strike some people as odd, given where all inflation has, but those people have seen their incomes grow a lot, and most of them are benefiting from a wealth effect from a stock market that, even though lately it's been a little bit more volatile, it's still very high related to long-term trends. That's giving people a lot more money and assets and things like that. So the wealth effect is alive and well, especially on the new vehicle side. And you can see that because, even though we know the average new car is somewhere around $50,000, there's really, quite a strong level of demand or demand supply balance in vehicles that are, $70,000 or above that too. So the top end, pretty good. The middle part of that curve in the K, they are feeling impacts of inflation overall. They have had some decent income growth, but it's not great for them. And then the lower ends have really felt a lot of that impact of that growing inflation, and that in a lot of ways it really cuts that consumer out of having their own vehicle. Now more than ever, when we look into the total price of having a vehicle with insurance and maintenance and repair costs and all of that. When we talk about dealer track credit availability and it expanding, some of it is a little bit nuanced in how that works. So if we see that lenders are more willing to finance lower down payments or negative equity or longer loan terms, that actually expands credit access. So it may be lenders are showing a little bit more willingness to go down into maybe what we would call a subprime customer that helps expand credit access and helps that index rise at the time when we're seeing some of the stress on the consumer overall.
Yeah, that's really helpful. It sounded like you mentioned and rattled off a number of economic, either policies or statistics, and all roads seem to lead to the point of affordability, and how that will play out, whether it's tying into the credit availability or the monthly payments, or even things like insurance, like you described. So I appreciate that, and we are also seeing the wealth effect directly in our wealth and asset data. And we have some things that we'll be looking to compare notes with you as we release those upcoming in the next month or two. But let's go ahead and shift then and start. We're going to start drilling a little deeper into things here from the general nature that we were just talking about. But let's jump into the shifting wholesale pipeline. So some of the things we've seen is that there's some traditional pipeline of 3-year leases. It could be fundamentally changing, or the recent expiration of the federal EV tax, credit aggressively cooling, especially as it relates to the new pure EV market. And we're seeing, and a lot of this stuff is things that I've observed from your talking around volume surging with respect to hybrids, or what about the secondary market? So there's a lot of things that are occurring in this space, specifically as it relates to that pipeline. What are we expecting over the next 12 to 18 months as we're looking at various policy shocks ripple through the system?
Yeah, we're expecting a lot of changes, but a lot of the impacts we've seen from the last several years all stem from the pandemic, believe it or not. Sometimes we're still talking about the pandemic and people are like, is this still a thing? But for the automotive market and for the used vehicle market, it's very much a thing. When we did not produce or ever make those new vehicles in 2021 and in 2022, and then we got more normal in 2023, those calendar years, right? That pulls supply out of the entire used vehicle ecosystem at large, and it will never be replaced. It's never coming back. Historically speaking, the number one input into the used vehicle market was an off-lease vehicle. You could see that the 3-year-old was the highest mix of vehicles in the wholesale market. It's the highest mix of vehicles typically in the used retail market. And so back in 2021 and 2022, we had lower new volume overall. And OEMs were really centered on selling those vehicles where they made the most money. That also meant they didn't lease many cars. So we didn't get many leases on the new vehicle side back then. Most leases are 3 years old. So that really pulled vehicles that would have come back off lease starting in 2024 down. So the wholesale market, the used vehicle market overall, started to see that number one supply input decline a lot in 2024. It was low all last year through 2025. And now in Q1 of 2026, we're just getting to the point where we're starting to come out of our bottoming period, if you will. And we'll increase a little bit in the second quarter of 2026. We'll increase quite a bit more in the second half of 2026, because back in 2023, we started getting more normalized new vehicle sales. Leasing rates rose a little bit. But the thing that really happened back in 2023 and in 2024 and in 2025 were those federal tax incentives really drove a lot of EV leasing. And we saw EV and plug-in hybrid lease rates on the new car side that were running hotter and higher than traditional hybrid or ICE vehicle rates. And that culminated to last year in 2025, when we actually saw for the full year pretty much EV lease penetration rates be over 50%. So that means that a lot of EVs are going to come back to the market. We're going to start to see those increase in share in terms of like their share of all lease maturities coming back, some this year, but it will grow this year in 2026. It will grow again in 2027 and 2028. So once we start seeing a lot more of these EVs come back to the marketplace, they're going to stay there for quite some time and be a much bigger part of the whole ecosystem. And, that could be kind of a counterbalance to what we've talked about with affordability, because EVs have depreciated more than some other vehicles have. And so we've seen last year that consumer adoption rates for used EVs grew. If that holds in 2026 and in 2027, that would be great because there's going to be more of these vehicles to come back to market.
Yeah, it's very interesting, especially with the direction of where I wanted to go. You're kind of leading me into my questions. And this specifically, I'm curious because you mentioned a lot of things around like tax refunds, the vehicles, and I've read and seen that $15,000 vehicle is the most in demand thing right now, both on the lower ends, but also people who may not want to pay some of the higher prices that they've been experiencing. But let's take these macro forces down to the showroom specifically as we're starting to get into looking at what are some things we may expect or what can people do about it with respect to that massive wall that could exist for a large segment of buyers. And we know tax refunds, as I mentioned, and you already were describing that with them being a little more, they may bridge that gap a little bit. But high financing costs, interest rates, et cetera, some potential concern. How does some of that potential fragmentation, alter how a dealer structures deals or partners with lenders on a daily basis?
Yeah, well, it makes the relationship between dealers and lenders all more important. It's always important, but for the dealer to transact and get that car to move, much of the time they need a lender that is willing to finance that vehicle for that customer. And no two customers are the same, right? They have different desires, different down payments, different financial impacts, and all that. So looking at all that, it means it's a lot of work on the F&I department, really to go out there and look through that. The good part about it is that a lot of dealers, a lot of lending institutions, and a lot of finance companies are leaning into using some of these AI tools. Those AI tools help them chew through some of these scenarios that speed up and like really grow the expansion of being able to look at wider options down the road. But you still got to like meet a consumer where they are in terms of the payment, right? Can they make that work? We've seen things where people are extending terms out. But the problem with extending a term to get the payment lower is that a lot of times if you go from a 72-month to an 84-month or something like that, you're also going to have a higher interest rate. Mm-hmm. So that may negate part or all of the benefit that you may see from going out a longer term. So there's just a lot of things to look at. But I do think it is, not lost on me that some of the ability with the systems and tools we have from a technological standpoint help us better, meet a consumer where they need to be and look at a range of options more so than we've been able to before.
Yeah, I think that's really, you're really helpful, especially as we're thinking about, consumers stretching their wallets and, trying to make that affordability. There's, clever things that are being done with respect to, terms, financing, deal structures, putting people in different vehicles. But on the other side of that, there's the opportunity for leveraging data. And, of course, we have a lot of, data at Equifax from, various things that we bring and incorporate. And we've already talked about the shifting risk profiles, and we've seen and observed that specifically in our data, such as some newer trends in this space in particular, like the rise in synthetic fraud, rise in credit abuse, those types of activities. Given your focus on some of the aspects about these economic concerns and strategic integration of data, what do you think is a takeaway that both lenders and dealers can have with trying to balance moving metal with managing those hidden risks?
Yeah, that's a difficult question, for sure.
That's why I wanted you to answer it.
Yeah, there's a lot. The thing is, and this kind of relates to what I was talking about just before, like having some of these tools that we have that are more advanced, they're faster, those are helpful in terms of looking at a whole picture of the consumer, looking at what the consumer's, scores have been in the past from a financing standpoint or their credit file, right? Thinking about where they may be in the future, even with some of this fraud that is ratcheting up, which is probably also a byproduct of these advances in technology that we have, and then make it more difficult for people or businesses to really know, is it real or is it not real? That kind of thing. There's all kinds of processes being put in place to try to, rein some of that in, if you will, and be diligent on that. It just means that really every day you got to stay on your toes, and you really need to build your system in terms of how you're going to finance a customer, help this dealer, look at this credit bureau or something like that. Your system needs to be almost updated every year now to put into place. How are your teams going to pull some of this information you haven't seen before, and utilize some of these tools to help you make better decisions with the data that you have in front of you each and every day? My team at Cox Automotive, we use AI. We talk about it weekly. Have people trying to look and see what we can do with it. It's basically changing the way that we work. I can't imagine that it's not changing the way lenders, dealers, groups of people and teams are working as well. But no one's got the playbook written yet on it either. So we've got to be in a space where we're open to adapting and adopting these new tools, and also rewriting how they integrate with our past to stay on top of what's going on right now.
Yeah, I couldn't agree more with you about the aspects of AI. There's been a lot of movement that has occurred there. And so I think at least knowing where you stand is probably the thing now, is to say, we're exploring it, we're doing this, but of course, time will tell with respect to the overall impacts. But let's, you mentioned all the things we've been talking about. I want to understand also, what is the impact on the dealer's lot in particular? So if we think about those factors, what's going to dictate who wins and loses on inventory mix and pricing strategy?
Yeah, the vehicle market has changed a lot over the past several years. We talk about the influx of EVs. That's one component of it. You've got this, plug-in EV vehicle volume that's different too. You have to charge those vehicles. So, dealers have had to get used to this, but we're also seeing still a lot of adoption and growth in the hybrid market, your traditional hybrid market, very, very strong marketplace overall. And we're still seeing that ICE marketplace decline a little bit. Some of what's happened on the new car side is that really we pulled back in terms of new car SAR. Our estimates for this year that it's going to be down a little bit on a year-over-year basis. But you think about impacts of affordability, where consumers are, how high these new car prices are, that we're in this market where that may limit what new vehicle sales are happening. But it's also basically putting more demand into the used marketplace. We've seen more higher income or upper middle income consumers moving down the chain into the used vehicle space. That helps things like depreciation. It slows down depreciation curves. When you have high demand, you usually have prices that are stickier on the upside, that kind of thing. And then you've got situations where, and this matters too, you think we're talking about the total cost of a vehicle, and insurance costs have gone up a lot. Maintenance and repair costs have gone up a lot too. And a lot of consumers have put that cost, that fixing that vehicle, the big piece, off for a while. They're maybe at a point where they can't do that anymore, right? Or it just doesn't make financial sense in the realm they are. And so maybe it's time for them to go change out and get a new to them used vehicle. Or maybe they're going to use some of their tax refund money to spring for that big repair in the car too. So, anytime we structurally increase the price of a new vehicle, I contend that we create a new used vehicle customer. And last year, when we had some of these tariffs and they're impacting the price of vehicles in 2026 still from that, because it operates on a big lag effect. you increase demand on the used car side. And so the used car market, from a supply standpoint, continues to suffer a little bit from those off-lease maturities we were talking about, but there's a lot of demand there still, and it's a really robust part of the marketplace. And I expect that that's going to continue to be that way for quite some time.
Yeah, that makes sense, and the curiosity here then as we drive into like the now what. The first thing I'm interested, but is understanding how you're going to spend your tax refund.
Well, I don't know if I'm getting one. We'll see. If I do, I have a daughter that's a freshman in college, so that very well may go to something like that. So I don't have any big plans. I will tell you in our data that at Manheim, though, we are expecting to see a very strong impact on the used vehicle market. And that's coming through in terms of demand on the wholesale market and then pricing levels too. So I believe the industry is very bought into expecting to see a strong spring market. And one thing we haven't talked about it explicitly, but I think matters a lot for tax refunds this year was that part of the increase that a lot of consumers are going to see are from those SALT deductions. Typically, those really are more applicable to a little bit of a higher income consumer, and a higher income consumer has a little bit of propensity to file their tax refund later in the tax refund cycle or tax return cycle. So that could extend the time period that we see this benefit from tax refund season against where we typically see it in other years.
Yeah, I was hoping to get a new guitar, but I'm paying for college as well. Yeah. So what I thought you brought up a couple things there as you were thinking about that from an impact standpoint. It's just which made me think about some of the high level. How do you recommend bringing in these macro concepts to micro day-to-day execution? And the reason I'm asking you is most people, like if they ask me about that question, I send them your way. And so I'm just curious where would you take that besides, because you can't send them to yourself.
The thing about macro trends is that seasonality is real. There are times of the year that are stronger, times of the year that are weaker. The new car market is the weakest in January, typically every year. It gets better as we move into March. March is the fiscal year end for a lot of these Japanese brands, Toyota, Honda, Nissan. So that usually makes March a pretty big time of year. I say that not to talk about what's happening right now, but to say, you need to maybe center your focus on over the next quarter. Like, what are some of the big trends that are happening? Like, we're in the spring market. It's tax refunds. We've got usually get this big push from Asian brands, right? Summer sometimes tends to be, we have another push into the August time frame, kind of like end of summer, back to school, whatever, for whatever reason, that can be a stronger point too. And then usually in Q4 is a little bit weaker. And so, it's really hard to plan your strategy and tactics around a year out, because I think we all have, and the dealer community has gotten really good at this too, to be nimble, especially over the last year with all of the tariff administration, anything that could come at you kind of any day. And we've seen that already this year in 2026 too. Everybody has learned to adapt to that as best they can, but having a viewpoint over knowing where we are in the cycle within an annual period, really getting geared up for, okay, over these next 3 months, I think these things are going to matter a lot to me, and really working that into your own process as kind of a guiding force. I think is something that could help a lot of dealers out there. So being a little bit more intentional and practical with your strategy, like almost quarter by quarter.
That's such a great recommendation, especially it's kind of like a health check. It's like they recommend servicing vehicles at a certain interval, should service their portfolios the same way. Yeah. So when we look at, thinking about, relying on solely on legacy metrics or other like 30-day supply model doesn't seem like it's enough anymore based on the things you're describing, the amount of iterations that are recommended, especially leading into things like incorporating AI, et cetera. And there's so many things that can happen from like the industry first analytics tools. And so when we think about where that is, like what are there any types of data that you recommend looking into? And whether it's like exact recommendations, I'm not sure if that's the specific detail that we need, but it's more like what are the types of data to look into, or any forward-looking indicators that could be brought into that regular ongoing process you described?
I've been in the data and analytics side of the automotive business for 6 or 7 years now. At Cox Automotive, before I came, I was kind of doing it for Nissan. Anyway, my point is, you think about over the last like 15 years, we have really, as an industry, kind of broken the mold of everything that we can look at. And over the past couple of years, that's sped up a lot. Our team has developed a lot of things related to lease equity. I know a lot of dealers have had that and the ability to look at it within like what is on their books. But we kind of have an industry view of it that helps guide, a lot of things like how many vehicles are going to return to market off lease versus being bought at residual value, things like that. We did the same thing on the retail loan side, where we kind of mine retail loan equity and see what those trends do. And we hear dealers talk about trade-in or negative equity rates of trade-ins. And, we can kind of like push that back to where it fits into some of the things we see too. And I just say it because basically we're all awash in data. We have to have information. A lot of the things we've built are very informational. I think a lot of the things, whether it's dealer groups, lender groups, risk groups, anybody in automotive or business over the past 5 years have developed a lot more tools to look at things. But you really need to stay on top of all of them, or look at the ones that matter more either to your specific business, dealer, lender, whatever, new car, used car, high-end vehicle, low-end vehicle, things like that. What matters more, whether it's credit metrics or day supply or turn rates or interest rates, there's all kinds of things. And then use these newer tools like AI or things like that to really help you synthesize that information. And I think a lot of us are still trying to figure out the best application for that, which ones matter the most. But right now, you can't just look at one thing. You kind of got to look at it all. And you can run kind of statistical models in your own business to say, these things correlate better with my customer base. But as we probably think about it, with all these EVs coming back on the used car side, your customer base may change some, or your vehicles that you have for sale may change some in the next couple of years. So I not to sound like a broken record, but I think being, kind of quick on your feet and nimble using some of these analytical tools that we have are just really paramount for your everyday managers out there to help you guide where your business is going.
Yeah, I would say it's more of a something I want to listen to on repeat versus a broken record, because that point hits home to a lot of these things. And so you mentioned something about things coming off lease, et cetera. And so I'm specifically interested in the potential electric vehicle wave that might happen. And how do you think that a strategy should pivot potentially to be able to successfully price, turn, or profit off of the incoming amounts of used vehicles that are expected, and especially now that buyers they aren't necessarily able to rely on the federal tax incentives to offset some of the costs like in the past.
Yeah, really good point there. I talk with a lot of big dealer groups, and I had one of them publicly traded not too long ago at the end of it say, well, so you're basically telling me I have to go sell used EVs. And I was like, Yeah, I mean, kind of. You know, if you're not moving towards that this year and into next year, you're really going to kind of be trying to work with a little bit of a hand tied behind your back. And I say that from a supply standpoint. You know, the supply into your newer used vehicles, anywhere from a 2 to 4 year old, has historically been driven by that off-lease product. Off-lease is starting to come back this year, but it's really the growth is going to be driven in the EV market. And we just talked about lease equity. You know, lease equity for traditional ICE vehicles and hybrid vehicles is actually a lot higher than it is for EVs. So there's maturities in like lease maturities, and then there's the return rate. How many of those actually come back to some type of wholesale environment? And that is driven a lot by those lease equity rates. And so having higher ICE hybrid lease equity rates mean those return rates will be a little bit lower. Also means they're going to be higher for EVs with that negative lease equity. So you're going to see a lot more of those. You know, consumer education is a big thing. There are a lot of dealer groups that have been against this. There are certain parts of, you know, the United States where you have to travel a lot. And, you know, EVs probably aren't like the best option for that, or the weather's really rough or something like that. I totally understand that. And I'm not saying that by any means. But as someone that had one of those original Leafs, you know, back in my days at Nissan that got about, you know, 65 miles on a charge on a good day. The vehicles that are coming back now are vastly different than those. And a lot of them are Teslas. You know, they've got a lot more range. But, you know, most used EVs, if they're getting somewhere around 200 miles, that's pretty good for people. It'll get you a lot further than you thought it would. The battery health has typically shown that it's held up a lot more. And the data we have so far right now also shows that those batteries are lasting for quite a bit longer than a lot of us thought they were going to when they were originally made, which means that the car is going to be around for longer. Now, the car doesn't need as much servicing, which is part of the reason that dealers maybe not be so, you know, high on it, because they can't get that consumer to come back and do oil changes, things like that. But they do chew through tires pretty quickly. And they will need, you know, those tires done more. And so I think there's the industry, we just kind of, this is coming, whether we like it or not. And, you know, there's going to be winners and losers out there. And there's going to be pockets of the U.S. Where it can be adopted more and pockets where it's adopted less. But you generally see it like the spider web, right? Growing across an adoption, even in places where it hasn't been so high before, starting to grow. But it takes time. And once this starts coming, like I said, in 2026, we're going to see at least through 2028 very high levels of off-lease maturities for EVs.
Yeah, I agree with that. And it becomes interesting. You know, I have a friend who purchased an EV maybe a year ago, and then they moved locations. And at the new apartment that they live at, they did not have a charger. And so it was a very interesting situation that it wasn't one of those things like, what is the infrastructure set up? You talked about the distances, where things are, et cetera. It's very complicated as we're moving through some of those things as infrastructure continues to build. But look forward to seeing it as well. So I'll close out with, you know, I guess you described the environment, could potentially improve for the second half of the year. What leading indicators should dealers be watching to ensure that they're positioned to capture that momentum as it potentially arrives?
Yeah, I mean, you know, it's early March. We're going to continue to see tax refunds come in. You know, as we talked earlier in the podcast, consumers have a lot of demands for where their tax refunds are going to go. So, you know, we're expecting to see pretty good translation from consumers to vehicles, new and used, in terms of the purchase rates. that will be really key to watch, like how those ratchet up over the next several weeks. So seeing like what happens with tax refunds, is that translating, and to what extent over rates from other years, because it's seasonal, right? So do we see that translating to vehicle sales? That'll matter a lot. One of the things we had just started seeing that really is going to matter a lot, the Fed cut rates 3 times last year. So the Fed funds rate's coming down, not expected to see the Fed cut again into June and then the second half of the year. Some of these things with like the Supreme Court ruling against the tariffs, if we see a lesser impact on the economy from tariffs, meaning that we see lower levels of inflation, that takes time to come through. If you start to see that in the monthly data, though, and how people talk about that, especially in the second half of the year, I think that does free us up for seeing a little bit more, Fed cuts to the downside in terms of rate impacts. And that's the stuff. It takes a bit when the Fed cuts to see it into mortgage rates or to see it into used or new vehicle interest rates, how that transpires. But those are things to really keep your eye on. And, just about a week or so ago, we saw the 30-year mortgage rate go under 6% for the first time since September of 2022. And that doesn't sound like that long ago, but it's 3.5 years ago now. So we've had these higher rates. And one of the really interesting things about automotive is that, there's probably a lot of pent-up demand for people to move houses, right? Or to buy a house or something like that. And there's a lot of correlation between buying a vehicle and when you move and home. So if we see mortgage rates, continue to come down a little bit, drive a little bit more activity, and the mortgage side, people moving, things like that, that's probably fairly stimulative for the automotive market as well.
Well, that's about what we had today. So I do really appreciate your time. Hopefully we can check back in midway through the year to see some of the things and do some comparisons of what modifications would you recommend at that time. So I want to thank you again for joining us today. And for our listeners who would like to learn more, where can they find you?
Yeah, we have our Cox Automotive Market Insights newsroom page. That is the best place to go. We publish a lot of things every week. I have a team, all kinds of stuff that we put out there. We do regular things. At the end of this month, we're going to do a webinar for about an hour. And then we do quarterly calls on the Manheim Index and things like that. So whether you dial in and can go and listen to that, a lot of people just download the presentations, that kind of stuff. We know that too. But we're out there really every week. Trying to bring the best information available in the automotive market. And I would encourage everybody to just go read up on that as much as you can.
Yeah, I would encourage it as well. You're definitely, obviously, a go-to resource for us as we explore those topics as well. So thank you so much for joining us again, Jeremy.
Yeah, thanks for having me. I appreciate it.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.